Everyone is watching for a repeat of 2008. They're looking for the same cracks in the system, the same fault lines, but they might be looking in the wrong place. This time, the challenge to investment banking won't be a sequel. It's a new story. A perfect storm, where old-world problems like runaway defaults are colliding with a force that Wall Street itself helped create but can no longer control: artificial intelligence. And this time, the political will for a bailout seems to have vanished. Part 1. The problem we know. To understand where things are going, you first have to understand the ground crumbling beneath our feet. For over a decade, the financial world operated in a fantasy land of near 0% interest rates. Money was cheap and borrowing was easy. Banks, corporations, and real estate developers all loaded up on debt like there was no tomorrow. Well, tomorrow is here. The first part of this crisis feels familiar. It rhymes with 2008. It's a crisis of debt. We are witnessing a slow-motion pileup of defaults that's been building for years. Take it from Jamie Dimon, the CEO of JP Morgan Chase. He has repeatedly warned about an investment bubble surrounding AI and the risks facing global markets. He's pointed to fragility in credit markets and warned that when the cycle turns, the adjustment could be sharper than anyone expects. His most memorable warning? When you see one cockroach, there is probably more. And the cockroaches are starting to appear. The U.S. speculative-grade corporate default rate, a key measure of how many riskier companies are failing to pay their debts, remains elevated. While S&P Global expects the rate to ease to 4.0% by September 2026, it remains a sign of persistent stress in the system. The year-to-date corporate default tally in late 2025 was 108, a figure that signals ongoing financial strain for many businesses. This isn't just an abstract number. These are real companies failing, creating ripples across the financial system. But the real epicenter of this debt quake could be commercial real estate. Walk through any major downtown city, and you'll feel it. The empty office buildings and for-lease signs. The work-from-home revolution was the first shockwave, and now a tidal wave of maturing debt is about to make landfall. The U.S. commercial real estate market faces a critical test in 2026, with some estimates suggesting over $930 billion in loans will come due. Many of these loans were extended during the low-rate era, delaying the problem but creating a larger maturity wall for the near future. Imagine trying to refinance a half-empty office building with property values falling at interest rates that are multiples higher than the original loan. It's a nearly impossible equation.
And this is where the sickness could spread. Much of this debt is held by regional and community banks. They were the ones who aggressively lent to local developers. Unlike the Wall Street giants, they don't have trillion-dollar balance sheets to absorb these kinds of losses. The crisis we saw with Silicon Valley Bank in 2023 wasn't a one-off event. It was a tremor before the main shock. This is the classic old-school financial crisis. If this were the only problem, perhaps the system could handle it. But this is only half the story. The other half is a crisis that attacks the very heart of how investment banking makes money.
Part 2. The AI disruption. For decades, the business model of investment banking has been built on a simple premise: information asymmetry and human capital. Bankers were gatekeepers of complex knowledge. They had the analysts, the spreadsheets, and the experience to price a deal or structure a merger. Their value was in their brains, and they charged billions for it. That entire model is being rendered obsolete. The second and arguably more structural force hitting Wall Street is artificial intelligence. This isn't just about automating back-office tasks or high-frequency trading. This is about generative AI gutting the core high-value functions that have justified the industry's profits. Think about the life of a junior investment banker. It's grueling work, building financial models and creating pitch books. Now imagine an AI that can do a huge portion of that work in seconds. According to research from Citigroup, a staggering 54% of jobs in the banking sector have a high potential for automation.
Bloomberg Intelligence has projected that AI could transform or eliminate up to 200,000 banking jobs over several years, with entry-level roles being the most exposed. This isn't just a cyclical downturn, it's a structural change to the talent pipeline. But what happens if a new technology comes along that makes that scale replicable? The value of AI isn't just in doing the old work faster, it's in creating new capabilities that democratize financial intelligence. Why would a company pay a bank tens of millions for a valuation when their own in-house AI can generate a dozen scenarios before breakfast? Why pay enormous M&A advisory fees when AI can help identify targets and run synergy models? Industry analysts are putting staggering numbers on this shift. McKinsey estimates generative AI could add between $200 billion and $340 billion in annual value to the global banking industry, largely through productivity gains. Deloitte projects that investment banks could see front-office productivity gains of up to 35% by 2026. But here's the critical misunderstanding. This value isn't all going to be captured by the banks. A huge portion of it will be realized by their clients, who will no longer need to pay for services they can now perform themselves. The pricing power that Wall Street has wielded for a century is evaporating. The banks know this. They are in a frantic arms race to adopt AI, not just to stay competitive, but to survive. But this creates a paradox. As they invest in the technology that makes their traditional business model less essential, they may be accelerating their own transformation. And it leads to the second part of the AI threat, a potential AI bubble. Central banks are getting nervous. The Bank of England and the IMF have both warned about the risk of a sharp correction in the valuations of AI-focused companies. Even Jamie Dimon himself has expressed concern, stating he is far more worried than others about an AI bubble and acknowledging that much of the money being invested will probably be lost.
BlackRock, the world's largest asset manager, has pointed out the extreme market concentration around AI, though it believes this is a feature of the transformation, not necessarily a flaw. The financial world is making a massive, concentrated bet that AI will generate unprecedented profits. This is fueling a capital expenditure boom of historic proportions. What happens when these profit expectations aren't fully met? The bubble could burst. And this is where the two crises converge. The investment banks are facing a solvency problem from the old crisis of debt defaults. At the same time, they are facing a profitability challenge from the new crisis of AI. The very engine that was supposed to help them earn their way out of trouble, their advisory and deal-making fees, is being systematically re-engineered by technology. They are losing money on past mistakes while their ability to make money in the future is fundamentally changing. It's a structural shift that leads to a terrifying question.
Part 3. Why this time is different. In 2008, when the financial system stood on the brink, governments and central banks stepped in with trillions of dollars in bailouts, backstops, and guarantees. They saved the system. This time, that lifeline may not be there, and it's for two critical reasons: political will and practical reality. First, the political will is gone. The outrage from the 2008 bailouts never really faded. A Reuters Ipsos poll found that 84% of Americans believe taxpayers should not have to pay for the consequences of irresponsible bank management. Can you imagine any government today justifying another massive handout to banks in the court of public opinion? The political climate is simply toxic for another bailout. But even if the political will existed, a 2008-style bailout might not work. The problem is fundamentally different. In 2008, the crisis was one of liquidity and toxic assets. The core business model of banking was still considered viable. The solution was to inject enough money to flush out bad assets and restore confidence. Today, the challenge is not just about bad assets from the default cycle. It's a structural crisis of the entire business model thanks to AI. You cannot bail out a business model that technology is making obsolete. Pouring money into these banks would be like giving a horse and buggy manufacturer a subsidy in the age of the automobile. It doesn't solve the fundamental problem that their core reason for existing is changing. The AI disruption is a permanent, structural shift. The jobs being automated are not coming back in the same form. The fee compression from clients developing their own AI capabilities is likely irreversible. The knowledge advantage that bankers once held is disappearing. This is what makes the current situation so perilous. The debt crisis demands a solution from the past, a bailout, but the AI crisis makes that solution questionable for the future. Adding to this instability is a potential changing of the guard at the top of the financial system. Federal Reserve Chair Jerome Powell's term as chair is set to end in May 2026. While his term as a member of the Board of Governors lasts until 2028, a change in leadership during a brewing crisis is a wild card the markets are not prepared for. The giants of Wall Street are facing a storm they helped create. They embraced decades of cheap debt, creating the conditions for the current credit stress. And they championed the development of AI, creating the tools of their own transformation. Now they are trapped between the consequences of their past and the irrelevance of their future. There is no playbook for this. Navigating this new financial world can feel overwhelming. The rules are changing faster than ever, and understanding the risks is the first step to protecting yourself. If you're getting value from this analysis and want to stay ahead of these seismic shifts, consider subscribing to our newsletter. The link is in the description.
Part 4. What this means for you. A crisis on Wall Street never stays on Wall Street. The intricate web connecting the world of high finance to your daily life is far denser than most people realize. It's not an isolated storm in a distant metropolis. It's a weather system that inevitably makes its way to Main Street, affecting everything from the value of your home to the security of your job. And this particular combination of a classic debt crisis and a futuristic AI disruption will impact you in profound ways that might not be immediately obvious. Let's start with your investments and retirement. For well over a decade, a simple mantra governed the markets: buy the dip. Every time stocks fell, you could count on the central banks, led by the Federal Reserve, to step in with stimulus and support. It was a reliable strategy because the underlying assumption was that the system itself was sound and just needed a temporary injection of confidence. That era of the Fed put, the implicit guarantee that the central bank would always backstop the market, may be over. With no political appetite for bailouts and a crisis that attacks the very business model of banking, the old playbook is useless. J.P. Morgan has pegged the probability of a U.S. and global recession in 2026 at 35%. While that still leaves a 65% chance of avoiding one, it's a significant risk to take without the familiar safety net. This new reality is what BlackRock and others refer to when they talk about dispersion. This isn't just Wall Street jargon, it's a critical concept for your portfolio. It means the days of a rising tide lifting all boats are likely gone. Simply owning a broad market index like the S&P 500, the bedrock of most retirement plans, may no longer be the safe, diversified bet it once was. We could see a future where a small handful of AI winners continue their astronomical rise, propping up the entire index, while underneath the surface, huge swaths of the traditional economy, including banks, insurance companies, commercial real estate trusts, and old-guard industrial firms, face a prolonged, painful adjustment. Your 401k could look healthy on paper, but its stability might be resting on the performance of just a few mega companies, creating an illusion of diversification that masks immense underlying risk. Volatility will not be a bug, it will be a feature of this new landscape. Next, consider your job security, even if your career is miles away from finance. The investment banking industry is more than just a collection of firms, it's the circulatory system for the entire economy.
The deal makers who finance corporate expansions, the traders who provide the liquidity that keeps markets running, and the advisors who guide companies through IPOs, they are the gatekeepers of capital. When that system is fundamentally altered, the flow of capital to everyone else changes with it.
The AI-driven job losses within banking are just the tip of the iceberg. The true impact is the ripple effect. Think of a young, innovative tech startup. It relies on venture capital and, eventually, an IPO to fund its growth. If the financial sector becomes intensely risk-averse, that funding may dry up. Think of an established manufacturing company planning to build a new factory. If the cost of borrowing skyrockets or banks are unwilling to underwrite the debt, that expansion and the jobs that come with it may never materialize. This is the connection between Wall Street's crisis and your reality. The construction worker doesn't lose their job to an AI, but they lose it when the commercial real estate developer can no longer get a loan from a struggling regional bank. The marketing manager at a growing firm doesn't get replaced by an algorithm, but their position is eliminated when the company's planned expansion is canceled due to uncertainty in the capital markets. The very function of a healthy economy, allocating money to productive new ventures, is at risk when its primary engine is sputtering. Think of an established manufacturing company planning to build a new factory. If the cost of borrowing skyrockets or banks are unwilling to underwrite the debt, that expansion and the jobs that come with it may never materialize. This is the connection between Wall Street's crisis and your reality. The construction worker doesn't lose their job to an AI, but they lose it when the commercial real estate developer can no longer get a loan from a struggling regional bank. The marketing manager at a growing firm doesn't get replaced by an algorithm, but their position is eliminated when the company's planned expansion is canceled due to uncertainty in the capital markets. The very function of a healthy economy, allocating money to productive new ventures, is at risk when its primary engine is sputtering. Finally, let's talk about the cost of credit, the lifeblood of the modern consumer economy. As banks are forced to write down bad loans from the commercial real estate and corporate debt pileup, their own balance sheets come under intense scrutiny. To survive, they will have to become far more cautious. This translates directly into a tightening of lending standards for you. It could become significantly harder and more expensive to get a mortgage, a car loan, or financing for a small business. The dream of home ownership could drift further out of reach as banks demand larger down payments and pristine credit scores to offset their heightened sense of risk. Small businesses, which rely on lines of credit to manage payroll and inventory, may find their access to capital choked off precisely when they need it most. This credit crunch wouldn't be a temporary measure. It would be a long-term recalibration of risk, making the economy less dynamic and putting a financial squeeze on households and entrepreneurs alike. So what can you do? This is not about panicking. It's about clear-eyed preparation. This is not financial advice, but these are strategic principles to consider as you navigate this new world. First, you must understand your own personal risk profile in a way you never have before. It's time to conduct a personal financial stress test. Look at your investment portfolio. How much of it is concentrated not just in the financial sector, but in companies highly dependent on cheap debt? How much of your retirement is riding on the assumption that broad market indexes will always go up over time? Look at your debts. How would your monthly budget hold up if interest rates on your credit cards or adjustable rate loans were to double? Look at your income. How resilient is it to an economic downturn in your specific industry? Answering these questions honestly is the first step towards building a real defense. Diversification is no longer just a buzzword. It's a critical survival strategy. Second, prioritize building extreme financial resilience. In a world where the government has little appetite for bailouts, you must be prepared to be your own safety net. This is about building your personal bailout fund. That means having a robust emergency fund, not just 3 to 6 months of expenses, but perhaps more, held in secure, liquid accounts. It means aggressively paying down high-interest debt, freeing yourself from the very cycle of leverage that is bringing the larger system to its knees. Every dollar of interest you don't have to pay is a dollar that increases your personal stability. In an environment of uncertainty, positive cash flow is king. This might mean reevaluating your budget, cutting discretionary spending, or exploring additional income streams. The margin for error for individuals and families is shrinking, and financial discipline will be your greatest asset. And third, you must invest in yourself. The skills that were valuable a decade ago are being systematically devalued by technology. The new currency of the job market will be your ability to adapt. This means embracing a mindset of continuous learning. It means developing the uniquely human skills that AI cannot replicate: deep critical thinking, creativity, strategic intuition, and emotional intelligence. Don't just fear that AI will take your job. Learn to use AI as a tool to make you better at your job. The very same forces that are allowing corporate clients to bypass the banks can allow you to augment your own capabilities. The goal is not merely to be resilient, to bounce back from shocks, but to become anti-fragile, to actually grow stronger and more capable from chaos and disruption. Adaptability will be the single most important determinant of success in the coming decade. We are standing at the precipice of a monumental shift. The twin forces of a classic debt cycle and a revolutionary technological disruption have converged on the heart of modern capitalism, the investment bank. This isn't just another market downturn. It's a challenge to a business model that has dominated the global economy for a century. The cracks from the mountain of bad debt are deepening, while the disruptive force of artificial intelligence is simultaneously rewiring the industry's very foundation of profitability. The giants of Wall Street are finally facing a storm they can't fully control, and for the first time in a long time, they may be facing it alone. The question is no longer if a transformation is coming, but what the financial world will look like after it does. The transition will be messy and volatile, but it will also clear the way for something new. What that is, nobody knows for sure. But one thing is certain: the world that emerges on the other side will operate by a completely different set of rules. The old model's necessity is being questioned, and things will never be the same.